Interest rate update. Have you heard about the Federal Reserve's decision on rates and what it means for you? Here, we'll unpack the Federal Reserve's latest interest rate decision and what it means for your savings, loans, and financial planning. Expect to gain some valuable insights on how these changes could impact your life. So, the big news is the Federal Reserve, also known as the Fed, has decided to hold interest rates steady. That's right, no more hikes for now. But before you start celebrating, they've also made it clear that they're not ready to start cutting rates either. This is a big deal because it signals a shift in their approach towards managing inflation, which has been running above their 2% target. Now, you might be asking, what does this mean for me? Well, let's break it down. For starters, if you have a credit card, student loan, or any kind of debt, the interest rate you're paying could stay the same for a while. And if you are hoping for lower rates to refinance your loans, you might need to wait a bit longer. During their recent meeting, the Federal Open Market Committee, the folks who make these big decisions, removed some key language from their statement. This language previously showed their willingness to keep raising rates until inflation was under control. Now, instead they're saying, hold on, let's see how things play out. Fed Chair Jerome Powell emphasized this cautious approach in his news conference, and he said they're not looking for better data, but rather a continuation of the good data they've been seeing. This means they're watching the economy closely before making any more moves. Interestingly, even if not likely at this point, the Fed's statement didn't explicitly rule out more rate increases. They're keeping their options open, depending on how the economy performs. After all, this is a delicate balance, as they want to keep inflation in check without slowing down economic growth. Speaking of the economy, the Fed noted that it has been doing quite well, with solid growth and progress on inflation. But they also recognize that the economic outlook is uncertain, and they're keeping a close eye on inflation risks. Now, here's where it gets a bit more technical. The Fed has been on a bit of a roller coaster, raising rates 11 times and reducing their bond holdings by over $1.2 trillion. All these moves are part of their strategy to manage the economy and keep inflation in check. So, what's the takeaway from all this? Well, the Fed is basically trying to achieve what economists call a soft landing. That means they're trying to bring inflation down without crashing the economy. It's like trying to land a plane smoothly, not too fast, not too slow. And here's something interesting. Recent reports suggest that while the job market is cooling down, wages aren't rising as fast either. This could be a sign that inflation might start easing up without too much damage to the economy. So, the Fed's decision to hold rates steady is a cautious move in an uncertain economic environment. For us, it means keeping an eye on our finances and being prepared for any changes in the economy. And remember, whether you're saving, investing, or paying off debt, understanding interest rates can help you make smarter financial decisions.